Ajay Srivastava also joining us this morning. Ajay, good to have you with us. Let me start off then from the center of action at the moment, and that seems to be the banks once again. A lot of question marks on the way ahead from here, starting to gather traction once again, but we're also now seeing the close of the moratorium. So unclear really whether or not we will see any kind of stress build up. What's your sense, Ajay, when it comes to some of the key banking names?
ICICI move to sell the shares again in ICICI Securities tells the story that, at least for that bank, is going to be a story of keep divesting of its subsidiaries and booking profit. So obviously they're creating cushion inside, even after the issue they have made if they're selling off ICICI Securities to book profits. So obviously there is a dollop of bad debts or at least provisions coming their way. So to that extent, I think market is now started to value for some of the companies like SBI and ICICI, the breakup value to say that given the subsidiary value, whatever it is, your bank intrinsic value is next to nothing, or at least was next to nothing. And the fact that they are divesting it with ICICI means that monetization can happen, and therefore there is cushion for the bank. So I think there are two separate examples there. One is intrinsically strong banks. Second is ICICI SBI, which has got subsidiaries. And the third is a whole bunch of smaller banks. Now that is where you pick and choose. Is it the time to go into the smaller banks? I guess not. Is there arbitrage for the PSU banks? Perhaps yes, in a bank like SBI and an ICICI, HDFC, of course, is the portfolio. But one can now safely argue the fact that possibly, and I think possibly the fact that the re-rating of some of the banks with good quality subsidiaries is taking place at this point of time, and that is what is leading the charge. IndusInd, of course, had gone down so much that, as they always say, there's only one way but up. So I guess that's what's happening in IndusInd.
That surely seems to be the case. Ajay, hi, morning. Wanted to understand what is it that you're making of the entire online grocery business now, with the weakest and the strongest player now merging hands. That's Reliance as well as Future Retail. What happens to names like Avenue Supermart? Because now the grocery revenue of Reliance actually becomes 2.5 times larger than D-Mart post this transaction.
I always have believed, and I've lost out on that D-Mart is always an expensive stock. So leave aside the fundamentals, the stock is fairly expensive, but I would tend to believe that their business model would survive. How long this continues, I don't think so. The way the world works is going to be one monolith charging the whole system. Is not going to happen this way. So to that extent, there will be competition at that point of time. And number two is, we got more than D-Mart, etc. We got other players like Milk Basket, etc. coming into the place, unless they also get sold off. You got Amazon sitting. So, it's going to be a competitive space. For a short-term bump, yes, that you got market share and so on. But it's not going to be an easy game to make money, because there are going to be 3 to 4 players, strong players in the market. And sooner or later, whether it's Monopoly, Restrictive Act, etc., will kick in to see that who can access what kind of an area or a geographical, monopoly. So I would not say it's a great negative for D-Mart, because one, rationalization of stores will take place when Reliance takes over, and therefore they might face less competition rather than more competition. Number of players have gone down, so one big player is out of the game. So that's always a great positive for existing players. That now, first there were 3, now there were 2, apart from Amazon and others. So to me, it's an advantage for D-Mart that one player is now less in the market. And the good part is, that player was struggling the most, so he had the most incentive, motivation to discount the transactions. That discounting motivation is to some extent gone, although Reliance is known with the telecom to do it. But I think in the more market with 2 or 3 players, you can get more money than 5 players. So overall, answer question is, for D-Mart, to me, it's a positive that one player is out of the system.
Sure. Ajay, have you been a buyer since our last interaction? Any spaces that are looking interesting?
Well, as I said, only the focus has been on the banks, which I mentioned the 2 names, which we bought into, which are the breakup value, which we thought had reached a point where the banks were valued at next to nothing. That play has done well. Apart from that, no, I don't think so. We have increased our commitments in the market at this point of time. And no matter how the buoyancy works, I am not in a mood to right now put more capital in the market, given what's happening in the economy. Yes, there are FI flows. Yes, there are this thing. But so it was there for the last time when the Nifty reached 12,200 and you saw what happened. We are on a little bit on the skeptical side, maybe in a minority. but certainly not committing more capital than what we had in the market last week. I don't think we will be doing this week.
What is stopping you back from committing more capital, Ajay? Is it pure vertigo, or you think that there is a froth which is there?
Well, okay. I don't know how to answer this, but I would say that after having so much worked in the market, etc., you get a sense that when is a good time to go big in the market, when is a good time to hold a hand. And something tells me that it's a good time to hold the hand to see how it goes. Yeah, sure, you may miss out some upsides in the market, but that's all par for the course. But if you put in context what's happening, petrol at 84 rupees in liter in India, diesel at the orange same price. Inflation is where it is going at this point of time. Gilt yields, you saw what has happened. So, and number 4, economy with all the 80,000 plus cases hitting somewhere down the line is got to give. And the first signal in the market is coming from what's happening in the consumer stocks. Absolute zero buoyancy in the consumer stocks. So if the economy, rural economy and everything has to move, you should see perhaps more buoyancy in the Nestle of the world, Unilever of the world. Maybe it's investor fatigue, maybe realizing the reality on the ground. I don't know which one it is. But signals are that this is not a market which has got a ground up support at this point of time. And you saw the GST issue playing out between states and centers. So if you put all that in one bucket, put FI inflows in the other bucket, I would tend to believe that caution could be order of the day, although in the past month or so, caution has not paid off. Let's be honest about it. But 6 different items playing on the economy at the same time, including the state and GST, FI flows on one side. Well, you can pick and choose which side you want to be. The number point is nobody's out of the market. Okay, so you may not make the last penny extra from the market, but as March and April showed you, keeping money on the side got you phenomenal dividend at that point of time. People who were fully committed could not get the best of the rally. People who were putting in cash could get the better part of it. So, well, discretion, better part of valor. Maybe, you walk away with less money, but at least you go and sleep safely.
Yeah, that's a great point. You need to be always prepared when an opportunity strikes. And, it's Buffett's birthday. So we like to remind our viewers that Berkshire Hathaway was sitting on tons and tons of cash, and when 2008 happened, they got bargains at throwaway prices. Imagine if you were sensible enough to buy in March, where if you did, and if you had cash, you've really hit a lottery in 3 or 4 months. So Ajay, my next question is that we are going through a phase where a lot of balance sheet repair work has started. Future Group, well, Reliance has taken it over. There is a flash which says that GVK Adani is buying the Bombay business. There is a balance sheet repair which is also happening in Shapurji Palunji Group. There's a balance sheet repair which is also happening in some other real estate builders. Does it make sense to now, again, you said that you like banks, but I'm saying that tilt towards corporate banks rather than retail banks, because if the balance sheet repair cycle has started in large accounts, then perhaps things could be very, very different.
Well, the corporate banks have a challenge. And the challenge is that most companies want to deleverage. So what you're left with really is working capital borrowings, which is also exposed to the commercial paper market. So the quantum of people who want to borrow money itself is going to be a little bit of a problem now for the next year or two. The only good part is that people are not borrowing so much overseas, so they're mostly relying on Indian borrowings. The second is, it is worrying trend. See, from the economy standpoint, deleveraging in such a large magnitude is never good for the economy, because that's not what you want to do in a company which is expected to grow. And number 3 is for the shareholders, a zero debt structure is the worst structure possible. Yeah, sure, you may celebrate a Reliance zero debt alternative and so on and so forth. But in terms of pure WACC, cost to equity, whatever way you work it out, if you're zero leverage, that's not the best way to manage the capital of the company at this point of time. So if you're not going to bet on growth, if no company is going to bet on growth, we all want to play safe with equity. We all want to sell off assets and pay off the banks at the end of the day. That's what is happening when you say balance sheet repair is going on. Therefore, who's going to bet on the economy? Where is the growth going to come from? How can state governments and central government keep spending money? So the driving point is, why deleveraging take place is obviously because the economic environment is not supportive to even earn the rate of return equal to debt interest, which is one of the lowest in the decade, and repay the loan. Now, if a corporate doesn't believe it can make 8% rate of return to repay the debt at that point of time, then what is the assumption we base on the economy? And that's where we come back and says why we said caution is that this kind of deleveraging that we've seen, no new projects, sell off if you have a project, doesn't matter, assets are gone is gone, and assets created over decades are gone, but still people are not willing to bet on borrowing. That shows you exactly where on the ground the economy is headed and why there is nobody willing to take a chance. Sure, there'll be some monopoly groups like Adani's or you mentioned and Ambani's, etc., who are sitting on, let's put it this way, an ecosystem which allows them to consolidate and buy out assets. But that's not really the India. And the rest of the India is deleveraging and saying, stay off business. In fact, smaller MSMEs, now that's the worrisome part. They don't want to invest money. We got so many people calling in to put money in stock market and saying, I don't want to put money in my business. Let me put in money in somebody else's business. Now that's what India is now becoming all about. Let's put money in somebody else's business.
Abha. The other, pocket, Ajay, which really has sprung up of late is the entire larger theme of consumption, be it your Indian hotels, Jubilant Foodworks, some bits and start moves in a PVR as well kicking in. Aviation, as we know, is getting back to somewhat its feet. Any opportunities that you think you would like to keep on your radar? I know you've only bought banks, but anything which you'd like to keep on your horizon at least?
Sector you said, there is only one sector which has a quasi-monopoly status, which is the multiplex sector. Now, if you have a longer horizon, you got to be there because you can't have multiple players coming in. There is no competition. The malls don't come overnight. And given what's happened to the economy, doubt very many new malls will come in for the next couple of years. So whoever's sitting on prime real estate is going to make big ticket money at that point of time. Whether it's going to happen this year, next year, somewhere point of line, you will start to live your life and start to go to movies. Sure, it could be a hard climb. But the fact is, they have a monopoly on the entertainment sector, at least out of the home entertainment sector. You can't substitute. Airlines, you can rent the planes, no problem. Hotel, abundance of choice, no issues with that. Discounting is rampant. So, and hotels never made money. Look at 20 years history. Which hotel company made money? If Oberoi could not make money for the investors for 20, 25 years, and Reliance, if you remember, had to come in as a white knight to save them from ITC, it's very difficult to make a case to invest in any hotel group. Therefore, among all the sectors you chose, you mentioned, I would say multiplex in India is definitely the best place to be for the longer term. You got to ignore 2020. As in America, they say, cancel it out, just cancel out 2020. But that's one sector where you would like to focus yourself. All others, I think, are highly competitive sectors with no history of returns. So to me, focus the capital. We already have a holding, so we've not increased it. But focus on only one sector, entertainment in India. That's going to be premium as people get out. And you cannot get you can't build a theater overnight. You can't build a mall overnight.
Fair point. Commodities as well, Ajay, seeing a very strong comeback. Be it metals, we've already been talking about as to how the yellow metal has been shining, but not precious, the ferrous and non-ferrous categories. Commodities like tea, coffee, sugar stocks have done really well. You think this is also a trend which one needs to keep on our radar and perhaps invest in as well?
Of course, we have a large holding in commodities. Whether we look at aluminium, we have a large holding there. We have a large holding in iron ore. Both prices have climbed up. But the key here is that if you're an investor, you got to keep seeing the commodity markets. Now, that's not easy, to be fair, but you will not invest based upon what the price of the share is. If you are willing to commit yourself to monitor the prices every day, aluminium, iron ore, zinc, silver, then yes, these stocks are wonderful, excellent dividends, but you need to watch the economic cycle. You saw the devastation NMDC, Nalcos, Vedanta, etc. had at the height of the pandemic, which other stocks equally had. So can't blame commodities. But the key difference of other stocks and this is these are driven by international prices. The rest of the stocks perhaps are driven more by FI flows and economy. So if you're willing to commit to research, please buy them. They are wonderful, absolutely in the longer term. You can't go wrong in commodity stocks. And good part, they give you dividend. Look at Nalco. All you got to do is dig. The guy has to just dig. If the price is right, he makes money. So he doesn't have to put up any new thing. Same as Vedanta, same as NMDC. So I think they are good stocks. The second one, which interestingly, I don't know how you picked up, was sugar. Most undervalued, most neglected sector of the economy, has picked up space in the last 2 months or so. You saw all the prices of sugar companies going up because government has been very good to them. And that's the first time in the history that the government has been good to sugar companies. Sugarcane prices are not going up. They're allowed to sell ethanol. Distilleries are coming all around. They're going into FMCG, hand washes, etc. And sugar prices have been kept good. Subsidy for exports, and the pricing is absolutely wonderful. So if you look at the top 3-4 companies, and we have holdings in them, whether you look at Dalmia Sugar, Balrampur Chini, etc., great stocks, wonderful management, phenomenal dividends, and very, very underpriced. Now, those have not been the market favorites. So let's be honest, they're not the kind of momentum stocks which traders love. But fundamentally, a very good place to be if the government policy continues.
Ajay, closing comments. The fascination in the market is to buy tech, buy digital, buy platform companies. And I think evidence is there if you look at IndiaMart, if you look at an MCX, if you want to throw in a BAC, I mean, technically it's a platform company, not a perfect monopoly, but it's a platform company. You know the names. Would you chance your arm in buying some of these so-called platform companies because that's where the new so-called bull run is there?
Okay, for disclosure, we have a holding in IndiaMart. We have a holding in Just Dial at this point of time. Both the stocks here. We have a holding in MCX and the other IEX as well. All the four that we discussed, we have a holding there. You already said it. There's a business case for these companies, not only because of the fact that this is where the world is going and they are positioned so well in this sector, and their valuations are dirt cheap compared to what's happening globally. So as a platform company, whether it's IndiaMart on the on the bulk side of buying, whether it is Just Dial on the retail side, whether it is IEX giving a gas exchange platform, this is the way the world is going. Look at NSE. There is no more that stock exchange. It's gone. We are the market leaders in the technology in terms of exchanges in the world. Same is going to IEX, same is MCX. Absolutely. And that is why one of the key things happening in India, nothing to do with Indian stocks, is why Indians are graduating and buying stocks in the US. You couldn't get those stocks in India. All the best platform stocks are still in the US. So whatever you have, 4 or 5 stocks, you must have them in the portfolio. They've run up a lot. They've gone up a lot. Let's take IndiaMart has gone up from about 2,000, I guess, to 3,500 or thereabout. IEX has not gone up very much, maybe 140 to 190 perhaps. But if you don't have it, you have to have it. If you don't have digital in your portfolio is all wrong. You're not even looking at what's happening in the world. Look at the way we are talking. There is no cameraman, there is nobody. Everybody's gone, it's digital. So yes, 100% buy, and not only buy in India, buy abroad. Yes, the prices have run up. So as I said, keep some powder dry. You will get a chance to buy. Don't worry about it. But if you don't have it, start today.
I don't want to get this one wrong for our viewers. Ajay, you still feel that a stock like IndiaMart or Indian Energy Exchange or IEX or perhaps an MCX can give market-beating returns from here also?
Our belief is that they will give multiples, because again, back to the point, not easy to recreate the system, not easy to do anything. IEX can't, okay, other people want to set up exchange, but perhaps it's very difficult. IndiaMart, very difficult. So the infrastructure, they got the subscriptions, they got the back end going. And the beauty of them is that today, if anybody wants to buy them out, say a Google or somebody comes to buy them out, they'll pay a fancy premium for the market entry in India. So to me, is not only market-beating returns, I think there will be stellar returns, but you got to be patient with them. They don't work every day. They work in spurts and bursts when the market fancy comes. So be patient. But I think all the stuff that we discussed will definitely be above market returns. And the good part, and that's the best part of this, is that this is a sector where you don't have too many choices to invest. So once you decide to go digital, you have no choice but to go 5 companies in India.
Okay. All right, Ajay, have a great day. Thank you so very much for joining us. I'm just going to shift attention to what's happening in the market right now. Banks, after a flying start, they're taking it slightly easy today. But again, banks have had a great comeback. When we started the year, banks were here, rest of the market was here. Now, rest of the market is here and banks are here. So a little bit of mean reversion. Other sectors have come down, banks have gone higher. But banks still will be called as a sector where at best you would say market beating returns in the near term are unlikely to kick in.